Ledger posting is like moving information from a journal to a special book called the ledger. This process is fundamental in accounting and helps ensure that all financial transactions are accurately recorded and organized. This ledger helps us keep track of all the money coming in and going out of our business. By maintaining a detailed ledger, businesses can monitor their financial health and make informed decisions. It's very important in accounting because it tells us how much money we have and how well our business is doing. The ledger provides a clear picture of the company's financial status, showing profits, losses, and overall performance. Think of it like this. You write down your daily expenses in a notebook, which is like a journal. This notebook helps you remember where your money went and keeps a record of your spending habits. Ledger posting is like taking those expenses and putting them into different categories in your budgeting app, which is the ledger. By categorizing expenses, you can better understand your spending patterns and identify areas where you might need to cut back or allocate more funds. This way, you can see how much you're spending on food, rent, or entertainment each month. Having this information at your fingertips allows you to make smarter financial decisions and plan for the future. In summary, ledger posting is a crucial step in managing finances, both for individuals and businesses, ensuring that every transaction is accounted for and financial stability is maintained. The general ledger is the heart of accounting. It's a big book or a computer file that holds all the financial records of a business. Imagine it as a giant filing cabinet with different drawers or accounts for each type of transaction. Each drawer in the ledger is called an account. We have accounts for things like cash, sales, rent, and salaries. When we post to the ledger, we're basically putting information about each transaction into the right account. This organized system ensures that we have a clear and complete picture of our financial position at any given time. This is essential for making sound financial decisions. Before we can post anything to the ledger, we need to record our transactions in a journal. This is the first and most crucial step in the accounting process. Think of the journal as a detailed diary of all financial events that occur within a business. Each entry captures the essence of a transaction, providing a chronological record that is essential for accurate financial reporting. This is like writing down each financial event as it happens. By doing so, we ensure that no transaction is overlooked or forgotten, maintaining the integrity of our financial data. Journal entries always have two sides, debit and credit. This dual entry system is fundamental to accounting, as it helps in tracking where money is coming from and where it is going. Debit means we're entering an amount on the left side of an account, which typically signifies an increase in assets or expenses, or a decrease in liabilities or equity. While credit means we're entering it on the right side. This usually indicates an increase in liabilities or equity, or a decrease in assets or expenses. Every transaction requires both a debit and a credit entry, ensuring that the total debits always equal the total credits. This balance is crucial for maintaining the accuracy of our financial records. This system ensures that the accounting equation, which is assets equals liabilities plus equity, always stays balanced. This equation is the foundation of double-entry bookkeeping and ensures that our books are always in harmony. These journal entries provide the raw data that we then categorize and summarize in the ledger. The ledger is where we compile all the information from the journal in a more organized manner, making it easier to generate financial statements. They're like the building blocks of our accounting system. Without accurate journal entries, the entire structure of our financial reporting would be compromised. Each entry, no matter how small, plays a vital role in painting the complete financial picture of a business. Ledger posting involves a few simple steps. First, we identify the accounts affected by a transaction from our journal entry. Then, we go to the appropriate account in the ledger. Next, we enter the date of the transaction, a brief description, and the debit or credit amount from the journal entry into the corresponding account. Finally, we ensure that the debit and credit sides of the transaction are equal. This process is repeated for all journal entries, ensuring that our ledger is always up to date and accurately reflects our financial activities. Section 5. Illustrative example of ledger posting. Let's say we buy office supplies for $50 in cash. This is a common transaction in many businesses, where office supplies are essential for daily operations. The purchase of these supplies is a straightforward example to illustrate how ledger posting works. This transaction affects two accounts, cash and office supplies. The cash account represents the money we have on hand, while the office supplies account represents the value of the supplies we have purchased. Both accounts are crucial for maintaining accurate financial records. In our journal entry, we would debit office supplies because we received supplies and credit cash because we paid cash. Debiting the office supplies account increases its value, reflecting the addition of new supplies. Conversely, crediting the cash account decreases its value, showing that we have spent money. Now, for ledger posting, we would go to the office supplies account in our ledger and enter a debit of $50. This entry ensures that our records accurately reflect the increase in office supplies. Then, we would go to the cash account and enter a credit of $50. This step is crucial as it shows the reduction in our cash balance due to the purchase. This way, both sides of the transaction are reflected in our ledger. The debit in the office supplies account and the credit in the cash account must balance each other out, ensuring that our books are accurate and complete. This simple example shows how ledger posting helps us track our assets, like cash and supplies, and ensures that our accounting equation remains balanced. By meticulously recording each transaction, we can maintain a clear and precise financial picture, which is essential for making informed business decisions. Accurate ledger posting is the backbone of effective financial management, providing a reliable foundation for analyzing our financial health and planning for the future. Section 6. Common errors in ledger posting. One common error is posting to the wrong account. For example, posting a salary payment to the utilities expense account instead of the salary expense account. This can lead to inaccurate financial statements. Another mistake is transposing numbers, like writing $540 instead of $450. Carefully double-checking our entries can prevent such errors. Software can also help reduce these errors. By being aware of these common pitfalls and adopting good practices, we can minimize errors and ensure the accuracy of our ledger. Section 7. Practical problems and solutions. Problem. A business owner forgets to post a sales invoice of $1,000. Solution. Review all invoices and ensure they are entered into the sales journal. Reconcile sales records with bank statements to identify discrepancies. Problem. A clerk posts a $500 purchase twice in the ledger. Solution. Regularly review ledger entries for duplicate transactions. Implement internal controls like authorization procedures to prevent such errors. These practical examples highlight the importance of diligence and attention to detail in ledger posting. Section 8. Importance of accurate ledger posting. Accurate ledger posting is crucial for businesses of all sizes. It forms the basis of financial reporting, which is used by management, investors, and creditors to make informed decisions. When our ledger is accurate, we can generate reliable financial statements like the income statement and balance sheet. These statements provide insights into our profitability, financial health, and overall performance. Inaccurate ledger posting can lead to poor decision-making, legal issues, and even business failure. Section 9. Conclusion. Mastering ledger posting. Ledger posting might seem like a tedious task, but it's the backbone of accounting. By understanding the steps involved and being mindful of common mistakes, we can ensure the accuracy and reliability of our financial records. Remember to practice regularly, use available resources like accounting software, and don't hesitate to seek help when needed. Mastering ledger posting is an essential skill for anyone involved in accounting or managing finances. By mastering ledger posting, you gain valuable insights into the financial health of a business and contribute to its success.